All right, guys, welcome to our lunchtime edition of Grid Philadelphia's How to Buy and Hold. Um, I, of course, am Matt Greene. Let me get my screen over here. And as many of you know, I am an agent with Coldwell Banker Realty of Greater Philadelphia. And I am super excited to have Todd Miller with us, who many of you also know is an agent with our office and also the founder of Bricknest Properties. Todd, what is Bricknest Properties?
Absolutely, Matt. Thanks for having me. Bricknest Properties is the name of the company that really runs my rentals. I thought it'd be nice to have a separation between me, the person, and my wife who own the properties and the tenants. So we came up with a company, make it a little easier for buying and selling and stuff.
Awesome. All right, so for those of you who are joining the first time, Grid Philadelphia is part of the Grid Investor Network. There are, I believe, 16 or 17 local, hyper-local chapters with over 16,000 members. Be sure to plug in at gridinvestor.com. You can join the Facebook group. There are lots of cool opportunities, how-to videos. You can get off-market deals, all sorts of good stuff that are all related around investment real estate. Todd and I just introduced ourselves. A quick legal disclaimer that our opinions on here are just that, our opinions. You should always consult the relevant professionals if you have any questions. So let's dive right in. What is a buy and hold? You know, I always have to chuckle when I see emails come through the office. I'm sure, Todd, you've seen this, where agents are like, I have a client looking for, an investment piece of real estate and they want to spend this much money in this location. And my first question is, well, what type of investment, right? What does that mean? So what is a buy and hold? A buy and hold refers to a property that you purchase with the intention of renting it out. So essentially there are two main types of residential real estate investments. One is a flip, one is a buy and hold. We're going to be talking about buy and holds today. Considerations for buy and hold are sometimes similar to those of a flip. But Todd, let's have a conversation about this. So here's some considerations. How much free cash do you have to market for, buy, renovate, and hold the property? What are your strategies around this particular thought?
So when you invest in rental properties, which is what a buy and hold is, there's two goals. There's cash flow and there's appreciation. And oftentimes I see investors, myself, seasoned investors, even new investors, who aim for both targets and miss both completely. My personal philosophy is to invest for appreciation. And in that context, when you talk about how much cash you need to buy, to renovate the property, it's not as much as you would imagine, because you can bring in investing and lending partners. Hard money is a great example. I use hard money all the time. You can take your current properties that you have and get home equity lines of credit and use that as cash. You don't always have to tie up your own assets in the specific project.
We're getting a little bit of feedback there. Did everybody catch that?
A lot of feedback.
A lot of feedback. Who's giving me feedback here? Let me see who's not muted. All right. I'm going to mute everybody. There we go. All right. Well, thank you, Todd.
You're welcome.
So you just answered the second question too. What is your long-term strategy for real estate investing? So if your strategy, Todd, is for the appreciation, what do you look at or what do you look for in terms of cash flow? Anything at all? I mean, you're just looking to break even?
No. It's funny, if you aim for appreciation, you are gonna hit that cash flow target. It's a matter of time. I think if you aim for cash flow, it's a completely different business, because then you got to talk about cash on cash return and it gets a little more nuanced. But no, my goal, it's the 1% rule that most of us know. For every $100,000 I have on the mortgage, I try to cash flow $100 a month. Easy example: if it's $1,000 mortgage, $1,100 in rent, and that is, I'm well above that, but that was my initial starting point.
Okay. And tolerance for risk, what does that mean?
It's funny. I find this particular world of rental property investing to be almost risk-free. But the reason why I say that is because I spent so much time learning it and doing it. And when I first started, yeah, I was terrified, but they're all calculated risks. And if you have the right partners, like what's the worst that's going to happen? You sell the property, maybe you lose some money, you have a tenant not paying. You got to have those layers of protection around you. But for anybody new, the biggest risk is owning one, because if you have one property and one vacancy, it falls to you. If you have 5 properties and one vacancy, then you have the opportunity to have the rest of your rents cover that mortgage. So I think the risk is starting.
See, that's so interesting. And you guys, if you have some thoughts, please unmute yourself and chime in. Todd, when I think of tolerance for risk, what I think is more of a location-based tolerance for risk, right? There's kind of a thought process that you go into a riskier neighborhood, you pay less for a property, you can probably cash flow maybe more,
Sure.
But then the long-term appreciation, it's questionable, Okay, awesome. And then what is your tolerance for dealing with rehabs, contractors, tenants, buyers, and agents?
So
go ahead.
Yeah, no, I've never purchased a property turnkey, which means not in horrible condition. Everything I buy is atrocious, but that's by design. I like knowing the contractor's doing the work. I like knowing who to call if there's a problem. I do all my own leasing, so I don't have a big issue when it comes to tenant management. But the tolerance for dealing with contractors is you gotta have a lot of patience.
Yeah, right. Be prepared for delays.
Yes, absolutely.
All right, so these are good questions, guys, to ask yourself, ask your clients who are investors. Where do you want to hold rental properties?
Yeah, it's funny. Like today, I was like, oh, it started out a beautiful day, like a beautiful breeze, and now it's hot and nasty. Like yesterday was god awful. I thought I was going to pass out and running around.
All right. Sorry about that. Where do you want to own and hold rental properties? I hear a lot of people say, oh, wherever there's a good deal. I don't know. I kind of find like the investors that I work with tend to stick in the same pockets. Do you find the same thing, Todd?
Absolutely. Everything I own is south of Washington and South Philly over 4 zip codes, and I do not venture outside of that.
Why is that?
Well, I started investing there simply because I lived there, and it was comfort on my part. And then I started to see, oh, well, if it makes sense here, maybe it'll make sense 2 blocks away. And of the dozen that my wife and I own, 8 of them are within like 4 blocks of each other. And it just kind of happened that way over time. And I couldn't be more happy with the way that the portfolio has grown.
Yeah, isn't it also easier from a management standpoint if things
Absolutely.
are kind of close by? And then if you start buying neighboring properties, then you have some control over the long-term value because, yeah, all of that sort of stuff.
You also get underrated how important this is. You get referrals from your tenants for other tenants. And, I have houses that are across the street from each other. And my one tenant's like, well, my best friend wants to live in this neighborhood. So I didn't have to advertise. No commission had to be paid. It was very simple.
Yeah. How long do you intend to keep a rental investment? This is a super, super important question, right? Especially, guys, if you're agents working with investors, these are some of the qualifying questions that you should be asking yourself. How will you manage your first few properties? How will you manage your first 10 properties or 20 properties? Todd, you use a property management company, correct?
No, it's all myself.
You don't? Okay, you manage it yourself.
I do, and it's a conscious choice. I don't mind it. I don't love it by any means, but I don't mind it. Long term though, and when I buy today, I do underwrite for property management. So if that were to come into my business, it would already be accounted for.
Okay. Some other questions. What rate of return do you get from other investments? What rate of appreciation do you expect from real estate? All right, so renovating, buy and hold property. Now, Todd, you just mentioned that you like to buy things that are essentially shells and renovate them from the ground up. Rob Chavez, who is the founder of Grid, is saying that he prefers lower middle market properties. I have 2 rental properties. both of the rentals that I own kind of fell into the same category where they were more or less move-in ready, needed some things to be fixed. So I think that there are some different thoughts around this. One thing that he writes on the slide is high-end properties are nearly impossible to find at prices that support the rent. Do you agree with that, Todd?
100%.
Okay. All right, so if you are doing a renovation on something that doesn't need a full rehab, fix what's broken. I think a lot of times, just like if you are evaluating a property to renovate and sell, you want to renovate to the quality of the neighborhood. So if you're buying a rental property, guys, and let's pretend that the average rent in the neighborhood is $1,500. If you go put in a $100,000 kitchen and want to rent it for $200,000, the neighborhood's probably not going to support that. So make sure the property is clean. Make sure, obviously, everything is working properly. Don't go overboard, because ultimately, when you go to sell the property, you're probably going to have to re-renovate anyway. Property management. This is something I really don't know anything about. I don't know, Todd, if you can chime in here and walk us through these bullet points.
Yeah, I'm more than happy to. And when I was preparing for this, I was looking at this piece thinking how important this is to consider whether you want to manage or not yourself. Because there's a point where everybody has enough of the management piece. I agree with the 8% to 10% of gross rents is what you have to pay in a monthly fee to a property manager. The thing that I've heard great feedback on for property management is you don't have to deal a lot with the maintenance calls or the vacancies. Now, as an agent and somebody in the business, I don't mind the vacancies. And I have friends who say, "Oh, I won't invest because I don't want my phone to ring at 2 a.m." My phone has never rung at 2 a.m. And if it is, it shouldn't be next to your bed anyway. So those middle of the night maintenance calls, like I tell my tenants, if there's a fire, get out, call 911, then call me, right? I'm not the priority in that example. But property management is a buffer between you and your tenant for everything. The thought with property management is you can just sit back and collect the checks and not have to worry about anything. Though I find that to be not overly true.
Yeah. Okay. And do you agree that here in Philadelphia, the average going rate for property management is 8 to 10% of gross rents?
Yeah, for some, and then some of the more expensive, maybe what people would consider better or even higher. And most rents just aren't there to support that in my world today.
Ryan Harsh, I see you. Do you use a property manager?
Yes, I do.
You do. Talk a little bit about that.
It's the best thing I ever did in my life.
Right.
I'm the opposite of Todd. I have the enough money built in that I can afford it. But I'm getting a pretty good deal from my property manager. I mean, I will say I'm getting crushed right now, actually, on a couple things because some major renovations going next to one of my duplexes, and they moved a wall, so I had to. So in that aspect, like I'm basically doing it all myself, anyways, because you need to be involved when it's that big of an issue. And I have a leak in one of my roofs. But as far as the day-to-day, stuff, it's worth it to me to not have to deal with it. Todd's a little different as a real estate agent. You can rent out your own things. I just don't have the time to do that. I don't have access to the MLS myself. You can do it on Hotpads. You can do it on Craigslist on your own if you want to. But for me, it's just peace of mind. And I don't personally live off my rents. It's more so of a long-term play to have a retirement and pay these things down and, be able to live off it later in life. So for me, I'm not trying to, get as much money out of it as possible right now. So it's worth it for the peace of mind in my mind. But I would say I disagree with that first bullet point because I've yet to find someone that will only charge me a half a month for a turnover, though. It's definitely a month.
That's such an interesting point that you brought up. I keep forgetting that as a licensed agent, we have access to all of the PAR lease documents. We obviously can market and qualify and, screen for tenants ourselves. So that's, I think that's kind of an interesting differentiation.
That's a huge bill, being able to rent that out yourself. I mean, it costs me probably $1,000 a month in just turnover fees, so it's a big nut if you can do it on your own.
Yeah, for sure. All right, loan considerations. Todd and Ryan, for that matter, I'm sure you guys can both walk us through some of these. I purchased both rental properties that I own with cash, so I don't really know a ton about financing as it comes to rental properties. Todd, why don't you walk us through these bullet points? And Ryan, please, I would welcome your thoughts as well.
Yeah, thanks, Matt. I think for a new investor, if you can understand the loan piece, everything else falls into place. This is, in my opinion, the hardest part to understand. But with great partners like Ryan Harsh, who I've used in the past, you do have an opportunity to not have to be an expert on it. So if you buy a property upfront, already done with cash, most lenders will require 20 to 25% down of cash in it. You do get the 10 properties that are conforming loans, standard conventional mortgages. After that, you get into the commercial lending. It's a whole nother animal. I've just entered that world. It can be daunting at times. The LTV, loan to value, isn't as high. You might have to leave more money into it. They look at this thing called debt service coverage ratio, which just means that you have to factor a percent of your mortgage versus your rent. That's a little down the road. But the best way to do it is to build the equity yourself and then go to a lender like Ryan and say, all right, I bought this house for $100,000. I put $100,000 into it. It's now worth $300,000. Can you help me pull my money out? And Ryan, why don't you dive into more about that and how the pity payment works and everything else?
Yeah, I mean, there's a zillion ways to kind of skin a cat on this one. So there's a lot of different, you can try to go the conventional route, which can be a little bit more documentation, full docs, full everything, full underwriting. Used to be kind of worth it. Since March, the government said they're, going to buy a lot less investment loans than they used to. So that's unfortunately pushed those interest rates up to a point where almost it's in line with the LLC loans anyways. So if you're looking for that liability protection, it might not cost you that much more to buy in an LLC. But that's going to be your standard debt to income ratio, personal income versus your personal debt. 25, you could put 15% down on single families. Volatile is going to be 25% down no matter what. Or you could go the conventional route, which would be more, or the LLC route or commercial route, which would be more your debt service coverage ratios that you're talking about, asset-based lending, where we're not looking at your personal income at all. We're typically only looking at the income of the property itself. For our specific products that we have, it's a debt service coverage of 1 or more. 1.15 or more gets you better terms. But that's a little bit, as long as you have a pulse and a credit score and enough money for a down payment, and you're buying a house that makes sense, you're going to qualify for that loan, So that one's a little bit easier, but you're going to have points involved, typically a higher interest rate, but it's not that much higher than it used to be. I mean, you're looking at 4 to 5.5%, 6%, which might sound high, but ultimately, we're not comparing rates here. We're comparing payments and what kind of cash flow, right? So who cares what the rate is if you're hitting your cash on cash or your ROI or your cap rate or whatever you go by. I mean, I prefer cash on cash for myself, but there's a bunch of different ways to look at it. And then you can also have the LLC protection. And there's no cap, you don't have the 10 property cap. So if you have 10 properties that are financed, Fannie may not even be an option anyway. So
Matt, can I add that, because Ryan made so many great points, but I think something that I wish if I could go back in time, I wish I would have been more liberal with the loan, with my conforming loans, the 10 that I got. Because looking back, a lot of them would have made sense in LLCs. And, maybe you save those 10 for some triplexes where you are trying to get the better terms. Because today, anything that makes sense in your personal name can likely make sense in an LLC. So pepper them while you can. And if you want to run the scenario, Ryan can absolutely do that for you.
Ryan, I have a question. This may be a novice question, but I'm curious. I'm sure I'm not the only one who might be wondering. When you purchase a rental property in your own name and then you purchase a second property, at what point in time, if you're cash flowing, I don't know, $400 a month, does that count towards your income? Is it the next year?
Question.
So you can count it immediately.
Oh, really?
So if it's within the year that you bought it, you can use 75% of the gross monthly rents towards your income.
Wow.
If it's after your first tax return, it's a cash flow calculation based under Schedule 8. So you're going to take your net profit, add back depreciation, mortgage interest, taxes, and insurance, and then divide that by 12, and that's going to be your monthly rental amount that you can use to offset your mortgage payment. So.
All right. Any other questions, guys? This is like.
There was one in chat that Dave asked. Do most property management companies get commission on rents collected versus what is owed? Ryan, you want to take that?
It is 10%
Yeah.
every month, or whether it's. I honestly depend. You could talk to your property manager. If it's vacant, I would argue, you shouldn't be paying anything on that. But obviously you're going to pay a broker commission. But whether, I don't know. It's that would be in your agreement with the property manager. And each one might be a little different.
If they're putting in an MLS, though, Ryan, they would have to pay at least a half month to the tenant agent, right?
Well, yeah. If they rent out the property, you owe the month, whether that tenant ever pays you $1 or not. Now if the tenant never moves in, I'd argue that they owe you the money back, right? Because they're the ones that are supposed to be placing the tenant. But if 3 months down the line that tenant, gets evicted or leaves or whatever, there's some, like, I think I have one of my property management agreements. I have more than one because I have different properties in different areas. But one of my agreements, I think if they move out within 3 months, I think they re-rent it for free. But again, you got to read your contract with the property manager on that.
Other questions on this, guys? All right, so sample rental deal, a $250,000 townhouse that needs $10,000 in work to be able to rent for $750 a month with a $75 a month HOA. Wow, where is this? $75 a month? Tenant pays utilities, landlord to pay $4,000 a year in taxes and $1,200 per year insurance. Todd, is this a good deal?
It's so impossible to find this. I'm trying to comprehend it. No, I don't think it's a good deal, and it's definitely not a good deal for me in my model.
Yeah, I'm going to just go to the next slide because I'm not really following this one either.
Yeah.
Okay. Let me go back. So again, I want to defer to Ryan, if I can defer to you, because again, I don't totally understand when financing is rolled into the equation for rentals. Can you walk through what this slide is saying? 75% LTV, 5%.
It looks like, I have kind of an Excel spreadsheet that I would pump all this stuff into, but it looks like you would take a 75% loan to value on that, which would be 206, 250 for the loan amount. Maybe you just use like a 4.5% interest rate. It's not a good deal. I don't know. It depends on your stuff, but you're looking at $1,045 a month in principal and interest. You got to add taxes and insurance on top of that. So $100 for insurance. Taxes were $4,000 a month, which I believe is so $333. You're going to cash flow like $100 before you can take into account your lost rents or your repairs or your broker fees or your property manager fees. Because as Todd says, I would always underwrite as if you're going to have a property manager, even if you're planning to manage it yourself.
Okay, so here it actually breaks it down. I'm sorry. I was thinking that the slide was just asking us to figure out whether or not that was a good deal or not. Okay. There is a question from Devin. Devin asked for Todd, what is the model that you use to determine if something is a good deal?
Good question, Devin. Thank you. I look for a very basic, how much money do I need to leave into this project? That's the first question I ask myself. Again, easy math. You buy a house for $100,000, you put $100,000 worth of work into it, it's worth $300. The way that my refis are working, I could pull out 225. Now that $25,000 spread is in profit because I'm paying hard money interest. I have to pay builder's insurance and then homeowner's insurance. But on paper, if I could accomplish that, that's a great deal. Even if I have to leave 5, 10, maybe 15 grand in every project, I don't mind that so much because I know at those numbers, I'll cash flow more than enough to cover any vacancy and any maintenance. Also, Devin, the best part about doing a full renovation up front, you likely, if you hire correctly, won't have any maintenance the first 3 to 5 years that aren't quick fixes. And if you work with the right contractors, they stand by their work. So that's the model I try to follow.
Todd, how about you out of curiosity?
What? Sorry.
I'm sorry, Ryan, how about you out of curiosity? What's the model that you use when you're acquiring rentals?
You know, I'm a cash on cash guy. So that's why I was like looking at that thing and I'm like, yeah, you know, it might be a bad deal for somebody, but a good deal for someone else, you know, because if you can, I mean, you're not rehabbing in that specific scenario, but if you're rehabbing and you're able to pull all your money out, you know, but you make $50 a month at the end of the month, but you spend $0 to buy a house. I mean, it's probably not a bad deal, right? But it also depends on the person. Somebody might look at that deal and say, well, I've got a ton of money in the bank. I don't want to invest in the stock market. I'm already investing in the stock market. I want to invest in something else. And they want to put 50% down on that property. And then it does cash flow and it makes sense for them. So it's different for every investor. I personally am a cash on, you know, how quickly can I get my initial investment back is my issue. You know, I try to stick to 25% equity on my total portfolio at all times. So I don't really want to leverage myself higher than that. And then as far as like, you know, the actual return on a monthly basis or cash flow, I kind of look at that as like a general portfolio number rather than a property by property number too, because like I said, you know, if I can buy a property, but I can cash out refinance at the end and get most, if all my money back, I might be willing to take a lesser, you know, cash flow on a monthly basis.
Well, and Ryan too, like, you know, I don't go into it that mindset, but if I have to leave 10 grand or 5 grand into the job and I'm cash flowing $250 a month, I'm going to make that back in no time. And
Right.
then, so it's not always about the refi number, though it's important. But, you know, if you can build a war chest of like 30 grand that you can play with as you're investing, it's a huge pressure relief. So I love that.
Agreed.
All right, guys, so some
like
final
cash on
thoughts here. Owning individual properties as rentals is a long game of accumulating assets and paying down loans to increase cash flow and build equity over time. The second thought, Todd or Ryan, if you can help me understand what this means, because I don't know. We like to buy rentals closer to 100 times the monthly rental rate.
Yeah, I don't know what that means.
All right. Okay. Which would be very difficult to do in an upmarket. A deal that makes good cash flow as a rental will also probably be a good candidate for a fix and flip. So you have a backup plan if the rental doesn't work out. That's interesting. The numbers for loans, et cetera, is the same as for buying multi-unit apartment buildings. In fact, getting the loan can be easier than with a single family house, and you can often add value and raise rents with property improvements easier than with a single.
Hey, Matt, can I mention the potential to flip a rental property if it doesn't work out during your rehab?
Yes, please.
So every time I evaluate or underwrite a property, in my head, I'm like, man, I could make so much money on this flip, right? You could make 50, 60, 70 grand up front, but rather than $200 a month. My opinion is you can never go wrong holding a property long enough. Because if you do hold it long enough, somebody's paying down the debt, your tenant, you will find a way to get appreciation. And even if you don't, you're still going to make all that money while you're holding it. And if you have a next generation, I have a son and another one on the way. If you have a next generation, they'll thank you for it one day. The guy who got me into this business taught me that, and I'll never forget it.
Dave Townsend has a question. Pros and cons of buying and renting a fee simple versus a condo HOA. I mean, Dave, I feel like that would be the same as you know, whether you're buying it to own it or buying to rent it. You know, the downside of a condo HOA is those HOA fees can can fluctuate all over the place, as can special assessments. So there's a variable in there that you can't always predict going forward. Guys, do you have any, Todd, Ryan, any thoughts around that?
Absolutely, Dave. My personal philosophy is have as few uncontrollables in your model that you can. An HOA is a huge thing you cannot control. I've never seen them go down; they only go up, and it just eats into your cash flow. With that said, I have a friend who owns about 100 condos and makes a killing. So contradict me all you want, but it's not for me.
Yeah, I don't like condos myself. First off, they appreciate much slower than single family homes and multifamilies, and they don't necessarily rent for anything more than a house. Yeah. So you're renting a 2-bedroom condo out for the same as a 2-bedroom house, but you might have a $400 HOA fee on that thing. Yeah. So it's, to me, I don't personally like it, but worked out for Al and Dom. So, you know, I could be wrong too. So, but I personally don't own any of them.
Ryan, aren't the borrowing costs higher for a condo too?
Oh, sorry about that. Yeah, the rate's technically higher unless you put 25% down or more. So if you put 20% down, 25%, you're going to get the same rate as a single family or a multi, which you can technically put 15% down on an investment property with a condo. So, but you're going to have if you put less than 25% down on an investment right now, your interest rate's just going to be crushed. You're probably high fours with points. You add a condo in there, it's an extra, 0.75 points on top. So, but if you're putting 25% or more down, it's a non-issue. But you do have to deal with the condo review. So, which is a good and a bad thing. So it's there to protect you and the bank, right? So you don't want to buy a house in, like Todd said, in an HOA that's going to go bankrupt next year. So that's it's a good thing that they have the review. Now, there's different kinds of condos too. You have your 2-unit multifamily homes that are condoed out, right? Like a 2-unit condo is basically just a duplex, a little bit less risky than maybe buying in an 800-unit building in Rittenhouse, where it's old and next year you're going to find out they need to spend $1 million on improvements because it's, they have issues with the roof or whatever. So the next thing you know, your HOA fee just went up $200 a month. So, so there's different things there too. I mean, I would be more inclined to look into one of those smaller HOAs than, and then maybe ultimately one day, if it's a 2-unit HOA, you buy the other one, so then you have full control and you don't have to worry about it. So that would be the difference for me, in those kinds of condos. I personally would stay away from the big buildings, but again, it works for people. So, everybody's got their own different.
I also think that Ryan's point, and my goal is to never sell any properties, but you have to have an exit strategy because you never know what's going to happen. Something happened to me and my wife doesn't want to deal with this. Selling a single family home is, as most of us know, a lot easier than selling a condo. So it's just one less barrier to entry should you choose to make that investment.
Yeah, just to springboard, quickly as a final thought, Todd, off of what you said, my dad, who at one point owned over 100 doors, his rule of thumb was, we talk about cash flow and all this sort of stuff, back 10, 15, 20 years ago when interest rates were higher than they are now, if he could get having a net zero cash flow where the tenant would essentially pay the costs of the asset, after 20 years, 30 years, 15 years, the tenant would essentially purchase the asset for you. So his philosophy always was, if you could just have not lose money each month, it would be a good long-term investment. Any other questions, guys? All right. Well, I would like to thank Todd for joining us. I'd like to thank Ryan, who is a sponsor of Grid Philadelphia and Go City Mortgage. I will forward Ryan's information as well as Todd's in a follow-up email. Just a quick plug to Ryan. I started working with Ryan because there was a deal that, I don't know if you remember this, Ryan, it was about 3 years ago, and it fell through at the last second, and Ryan came in and fixed everything and got the deal to close within a matter of a week or two, and so he's been my go-to ever since.
I believe it was a
Ryan. So happy to have you joining us today, and thank you guys so much. We will see you at the next Grid meeting on August 19th, how to fund your investment deals. Thanks again, guys.
Thank
Thanks for
you.
the invite.
Bye.